Hello, this is Patrick. Welcome to Chart Built Wealth, Profitable Investing with Technical Analysis. Well, we're into the new year and a good first day for the buy recommendations. And so let's get into that. I want this to be short and concise. So here we go. Let's start with uranium. Uranium was the newest recommendation just a couple days ago. And the ETF symbol is URA. That's the Global X Uranium ETF. And this is along the big picture on uranium. And after just a horrible, 8 or 9 years, uh, we got to a bottom. And from this low, we've had a five-wave advance into the top of what I'm calling wave one, according to the Elliott wave theory, which believes that trends or cycles go in waves of five. So we had one, two, three, four, five. The end of wave one, we had a two, it was a symmetrical triangle. And now we're into a third wave. And third waves, what do we know about third waves? According to the Elliott wave theory, they're the most profitable, they move the fastest, they are usually the big moves. And so within the third wave, we're going to have five waves. And so we had our first wave up here, second wave retracement, third wave within a third wave. Look at how that went straight up. And then we were getting a pullback into a fourth wave. On the top of this third wave, we got confirmation of the high. It's a higher high than any of these previous. And so it confirms that high, and that gives me a little more confidence that we have another high coming. We got a 26% correction on this decline, and I thought it was a good place to step in and purchase. Today, it was up 7.7%. Nice start. And let's take a closer look at this. This is kind of what we're looking at. And here it is. So it looks to me like there's two things that could have happened. We could have had an ABC correction, which is normal, especially since this second wave way back when was a triangle, the rule of alternation. And then we've had a bullish hammer last week. This is a weekly chart. Each one of these bars or candlesticks represents a week of price action. And then today we had a big up day. So either this is the end of the correction and we're going higher, or we could come up here and bounce around a little bit in a consolidation. So I'll be watching that carefully, but it's a good start. It's a good start for us. Uranium seasonality went bullish just the last week of December, and it should be bullish into the end of February. So let's see what we get. Seasonality is just a tendency. It's just one tool that we use to try to put together the puzzle. Second buy recommendation. This has been very slow and has gone sideways since July. When we actually the end of August, I'm sorry, we went with a buy recommendation at 22.77. We're at 23, so basically flat. Here's the big pattern. I like the bigger the patterns, usually the more reliable and the bigger the breakouts. And so this is the iShares S&P commodity index. So this is a commodity-based index with all kinds of commodities, but it's very energy heavy. It's about 70% in energy. So we need oil and natural gas to do well for us. However, this is a big pattern. 1, 2, 3 years in the making, broke out, came back within the pattern, and now we're consolidating right on that breakout line. So if we can get a breakout to the upside, I think this is going to go really fast, similar to platinum when I was buying that before the breakout, and sometimes that's a good idea, sometimes not. It's a lot of analysis trying to figure out what the potential downside is. So I got my stop at 21.5. And the potential upside is, let's call it 31, which is about 35% above where we're at today. So big upside there, but we need energy and oil to get going. This is the monthly chart of so this is a longer term chart, and you can see the big decline. You can see the five waves up here into the top. Looks a little bit like uranium, only uranium did break out and went higher, and now it's pulling back in a fourth wave, within its third wave. So here we are in the second wave consolidation. And what do we know about third waves? They're the biggest, the most potent. You want to get in front of third waves. So that's the big picture. That's why I think this is attractive. Here's the holdings in the index, 70% crude oil, natural gas, 16% agricultural. I'm bullish on corn and some of the ag names, and industrial metals, 7%, which is copper and aluminum, livestock. I don't really know exactly what's going on there. And precious metals, of course, gold and silver's been on a tear. I'm glad this isn't a big number. I look for many precious metals to consolidate for a while after their big runs, but we'll see. So this has been the underperformer, and we need to get that going for this to really take off. So we're going to take a look at seasonality. It was turned bullish in early December. It looks like it consolidates here a little bit, takes a little bit of a dip, but if you put this on a continuous chart, this is where you'd want to get involved. And in July, you don't want to own crude according to seasonality, which again is just one tool or tendency. But this is really important. I think this is in the back of my mind often. This is the Commitment of Traders report. That's the big futures report, and it breaks down the players in the futures market into three groups: the commercials, who are in the industry, so in crude oil, which we're looking at, that's the Chevrons, the Exxons, all the big players who know their business, and they have a pretty good idea what their crude oil is worth. They've never been net short because they're always hedging. They've never been 100% long because they have so much product. But here they are at the lowest on this chart by far, meaning that they think their crude oil is worth a lot more than it is currently. And actually, if you look at this chart going back to 2016, this is the most bullish setup for the big boys down there in Texas are on their products. So that's a bullish sign. And kind of walking right into that, we got Chevron. So Chevron, again, this looks a lot like the overall commodity index, GSG. This is CVX is a symbol on Chevron, and we got a 1, 2, 3 year consolidation. And again, the bigger, the better. The most usually more reliable and more profitable, bigger moves. If we can get above 160, we have a price projection at 212, which is 30% potential upside. So here's where we went bullish, and we were right on our stop here for several weeks testing that, and then New Year we get a big breakout. Not a big breakout. We get a big move with Chevron up 3%, and calendar years actually mark changes a trend for many things, namely currencies. You'll see big changes from year to year in currencies where the directions change, also in some commodity groups. So hopefully that's going to be the case with energy. Brazil, this is another play on energy. So I got three plays out of seven on energy. It's not totally energy because Brazil has many natural resources. They have a lot of minerals and things that are needed that actually the U.S. has a huge shortage of. MP Resources was a name that I bought and suggested on this channel that went up over 100%. Uh, Brazil is also one of those rich natural resource countries, but it has a lot of energy too. And so here you have one, two, three, four, five. It's funny, it's almost the same pattern as we saw in GSG, the commodity index, and Chevron, but this is even bigger. This is a 5-year pattern, and we broke out. Didn't chase, waited for that to settle back in around 31. I got a buying opportunity and had a decent day today. It was up about close to 2%. So the potential upside is 51, which is a 50% potential. Is that right? 20? No, that would be about a 60 to 70% potential move. Here's the point and figure chart. Again, those that haven't seen my videos previously, this is the least subjective chart. It's purely supply and demand, no interpretation on my part. And you can see we had a bearish trend line here, and then recently we got a bullish breakout, and it got up to 33, and then it pulled back to 31, and we got an opportunity to buy it there. So this confirms. This is also giving us a $55 price projection. So the potential upside is big. Healthcare, the great unknown, and a lot of people are going to be without healthcare starting now, and some premiums are going to go up, and there's going to be action in this space. So whether there's some sort of subsidy or what's going to come out of the current administration is totally unknown, but the charts is telling me to buy this. So we have a consolidation over a few years, and we have a neckline right here, a flat line, and we have a left shoulder, a head, a right shoulder. This is like a man or woman hanging upside down. And you measure from the bottom of the head to the neckline, you project that distance upward, and you come up with $140. So that's, 20% potential upside, and something that could be much bigger. This is definitely going to be front and center as we get into the new year. This is just a closer look at it. Left shoulder, head, right shoulder, neckline. We didn't chase. We waited for it to come back. We bought. We've had three bullish hammers in a row. Prices open up at the top intraday, intra-week come down. By the end of the week, it's back up near the top. So somebody is buying this support at 113 or so, and my stop is at 112. Okay, we're on. This is a little unusual, but I wouldn't recommend it except for I think it's could be extremely profitable and also help you in other parts of your life. So whether you have a bond portfolio, a stagnant bond portfolio. If you remember, I think it was 1994 when bond portfolios were down 22, 23%. And so if you're one of those people with a balanced portfolio with, let's say, 60% stocks, 40% bonds, fixed income, you were down actually in 94. I should have looked at this first, but I believe the stock market was also down that year. So people suffered quite a bit. And, this is just such a big change of character. So if you go back to 1980, you have declining interest rates. And so, here's the bearish channel, and interest rates kept going down, kept going down. They collapsed in 2020 down to 1%. and then they shot out of a cannon. And here we are up near 5%, so actually right now we're at like a 4.75. This is the 30-year treasury. And so after a big explosion like this, the trend has definitely changed from lower rates to higher rates. And then we get a sideways consolidation to work this off because it was so immediate. This is a sign of strength. It didn't correct this way, it corrected this way, at least so far. So the thought is here that rates are going to, after they're done consolidating, are going to go higher. And so whether you have debt, outstanding debt, or you have a mortgage that adjustable rate mortgage that's coming due soon, like I do, you want to lock in some of these rates, even though they're extremely high. I can't believe I have to do this. My 10-year arm is up, and I need to refinance at these higher levels, but I'm going to do it. And so let's take a look at the vehicle we use to make money in this. So as rates go up, a traditional bond or bond fund is going to go down in value. Okay. So how do we participate in that? How do we take advantage of that? Well, this is the ETF that I use. This is a 20-year short US Treasury. It's an inverse fund. So again, as bond prices go down and yields go up, the value of this goes up. And you also get a dividend. So it's really a good thing. So if you have a bunch of bonds outstanding, you might want to hedge them with something like this. I'm doing it to make money. So you can see the new bullish trend line 2020. That's when rates shot out of a cannon. So here we are stair-stepping higher. And this is just a short term. This is a daily chart. Each one of these bars, candlesticks represents a day. So this is no big long-term picture. The big long-term picture is if rates break out to the upside here, if they get up to a 5.25 on the 30-year treasury, then you measure the base of this, you're at 4 to 5.25. So they're going to go up to like a 6.75 or something, a much higher level. So that's the big picture. But short term, this little pattern I'm going to show you says we're going to 5.25, and then we'll see what happens. So I'm bullish on this, bearish on treasuries until we get up. We have a small inverse head and shoulder, head, right shoulder. And so I'll be moving my stop up here, but I'm looking for like a 24.8 on this. And then I'll probably go neutral short term and maybe get some sort of correction, or I'll sell a quarter of mine, or something like that. And we can talk more about that. But there's a lot of ramifications for that. I can't imagine like the stock market doing well if the 30-year treasury is at 650 or something like 675. And I'm not painting a bearish picture because I don't have that yet. So anyway, last but not least is corn. So again, like uranium, like the commodity index GSG, looks like we're entering a third wave here. We haven't got, this is at the infancy. So we definitely had 5 waves up. So that tells me the trend is up. And then it looks like we got a 3 waves down. There's a lot of overlapping waves here that tells me it's corrective. And on these last 2 lows, we got this is a monthly chart. So each one of these bars represents a month. So that's a big deal. This is big picture stuff. So as we hit these lower lows, we got higher lows here, and that's flashing a caution sign. Beware, a change of trend is coming from down to up. So that's where we're at. I've been long this for what, 3 months or so. And the reason also, again, seasonality plays a bigger deal in agricultural commodities, wheat, corn, soybeans, and you want to start buying these in October, and you want to sell these, in June because then they really tend to sell off. And I'm sure it has something to do with the harvest that's way beyond me. I'm just looking at the chart and and, and making a decision. Thank you for watching Chart Built Wealth, Profitable Investing with Technical Analysis. Please like and subscribe. Have a great evening. Happy New Year. All the best health wise and happiness. Thank you.